Global stock markets, which fell this week off the back of surprisingly strong US jobs data. Bond yields, on the other hand, surged on expectations that the robust figures would prompt the Federal Reserve to continue raising interest rates, which are already at a 22-year high. Now, numbers from the Bureau of Labor Statistics showed US employers added 336,000 new jobs last month, almost double the average forecast. And August's non-farm payrolls were revised up to 227,000 new positions. The unemployment rate held at 3.8%, but average hourly wages rose by just 0.2% month on month, missing analysts' expectations. Bond yields on both sides of the Atlantic quickly reacted to the stronger than expected jobs data. The 10-year US Treasury yield surged almost 5% within a couple of minutes, hitting its highest level in 16 years. The German 10-year yield, a benchmark for the Eurozone, surged nearly 3%, closing in on the 12-year high it hit earlier this week. And the blowout payroll figures have pushed stock markets around the world into the red again. Dow Jones Industrial Average futures dropped around almost 1%, while the S&P 500 and Nasdaq both fell more than 1%. The Pan-European Stock 600 index erased the gains it had seen before the numbers were released. For more on this, the founder of Path Trading's partner, Bob Iacchino, joins us from Florida. He's also chief market strategist and a co-host of the Futures Edge podcast. Great to have you with us, Bob. Let's start with the latest US jobs numbers. They smashed expectations for September and build on the strong jobs growth figures we saw both in August and July. What does this say about the state of the US economy?
Well, the U.S. economy, based on this number specifically, is still a bit of a mixed bag. Normally, when you see numbers like this, you can just close your eyes and say that the economy is strong, but it doesn't actually seem to be that way, in my opinion. Yes, this was a blowout number in almost every aspect. As you look through the figures, they were all fairly strong. We had a little bit of an uptick in the unemployment rate, but certainly still at historic levels. And we do have wages still rising, and they rose the same amount on a month-over-month basis as they did the previous month, which leads me to believe that some of the strike data is not in here yet. And by that, I mean the increased wages that came with some of the strikes here in the U.S. that were settled. The part that was a little troubling to me is the breakdown of the actual set of the headline jobs. Number one, you had another 95,000 leisure and hospitality jobs added within this number. Those jobs are full-time jobs, and they tend to be high-paying jobs, but they're also not stable jobs. If leisure and hospitality takes a drop, in part because of the inflation that consumers are feeling here in the U.S., those jobs can go away very quickly. And the second part of it, over 70,000 government jobs added there as well. Now, those are more stable, but tend to be lower paying. So when you look across this number, yes, the jobs market in the U.S. is still strong. And I'll throw one more piece out there. When we got the JOLTS jobs opening data a couple of days ago, the quits rate had started to fall. Now, the quits rate is how many people comfortably quit their jobs because they know there's another job out there. That has started to fall, and the increase in the pay that the people are getting when they quit one job and go to another actually fell by quite a bit. It was up at 16% at the high. It's up at 6% now, so a big drop there, which will keep more people in jobs and eventually bring this number down.
Bob, let's take a look at inflation in the US now, because we are seeing that figure ticking up slightly, which is something that no one wants to see. Consumer prices rose 3.7% in August, and that was up from 3.2% in July. What effect will these strong jobs figures have on the Federal Reserve's thinking, in your view? Are they likely to stay the course in terms of keeping interest rates high?
Well, this is a great question because it really depends on which way you're looking at it. Are you looking at what the Fed might do based on market predictions, which is a rate cut before the end of 2024, or based on what virtually every Fed governor, Fed president, and voting member of the FOMC has said, which is rates will stay higher for longer and are more likely to go up than down in the next year and a half? If you're looking at it in the second way, the latter, I think this kind of bolsters that case. Because again, regardless of what negative I can take out of the jobs number, the jobs situation in the United States is still strong. And every member, especially Fed Chair Jerome Powell, has said that there's likely to be a pain in the jobs market. And we haven't seen that yet. If you're looking at it as the Fed's going to cut rates in 2024, which again is what the market was pricing in prior to this number, we're seeing rates rise substantially as I speak to you right now, then I think that you have to kind of loosen up on your hold on that view, because it becomes more and more likely that the Fed, at the very worst, is going to keep rates the same. Right now, the market, from an inflation standpoint, is pricing in no lower than a 4.5% Fed funds rate going out over the next 2 years.
And what about stock markets? Because investors generally don't like the prospect of even higher interest rates, but we have seen a recent rally driven by excitement over AI technology. What's your outlook for equities?
So the balance in the equity market has been poor. We have the S&P and the Nasdaq both still up on the year. The Russell is now down on the year here in the U.S. That's the Russell 2000 index, and the Dow is almost flat. When you look at it from that perspective, if you took away the top performers in the S&P would be down as well. Essentially, if you do an equal weighted S&P, of course, the S&P is market cap weighted, you would see that the S&P would be down on an equal weight basis. So that tends to predict one of two things. Either these high flying AI influenced stocks like Nvidia and the rest, Microsoft, are going to come down and meet the broader market, or the broader market is going to rise up and meet the AI stocks. And I think the former is more likely. Now, that doesn't mean a huge sell off in AI. If you take Nvidia, for example, if Nvidia fell to $300, it would still be up over the last 5 years substantially. And you'd probably see a lot of buyers coming in at that level long term. But in my opinion, it does mean that the broader market is going to pull those high flying AI stocks down. And I'll point out one more thing, if I could. You're starting to see the inversion, especially in the twos to tens yield curve inversion, start to normalize. In other words, that inversion is going away. That difference is at its highest level in about a year and a half now. Typically, historically, stocks suffer on the reverse of that inversion, and
Yeah.
they don't bottom until the inversion actually steepens and normalizes again, and we haven't seen that yet.